Welcome back. Hope you're having a good morning. We kickstart the October series today and the final session in the month of September. But there are plenty of stocks to discuss. And Siddhartha Khemka, Head Retail Research at Motilal Oswal, joins us on the show. Hi, Siddhartha. Morning. Thanks so much for joining in. Well, let's address the IT pack. You have Accenture news overnight. Yields continue to remain elevated. And the outlook, I was reading a couple of preview notes for this quarter's numbers. IT shouldn't surprise too much on the upside, but stock prices are doing a thing of their own. How do you approach this space?
Yeah, good morning, Nigel. Good to be on the show early morning. If you look at what Accenture announced yesterday, there was a marginal miss on the Q4 top line. Along with that, the bigger concern was the weak deal booking and the modest FY24 guidance. All this would add concerns to the overall Indian IT services demand environment. And as I said, most importantly, the weak booking is something that is worrisome for the Indian IT services, given that the earlier expectation was that things would start recovering from the second half. But going by what the current environment is, even apart from what Accenture announced, we can clearly look the economic environment in US is not in the pink of health. So I think the recovery is now at least 2 more quarters away. The commentaries towards the end of this quarter, whenever we'll start getting that will kindly confirm that things are not looking that rosy. Stocks have come off from their peaks. Valuations are not that high. So don't expect much of a downside, but also don't expect a recovery in the share prices in the near term.
Okay, don't expect much of a downside, but not even a recovery in the share prices. Got that. I wanted your thoughts on how to approach some of these infrastructure and power names, right, that have been doing pretty well. The biggest gainers this month on the Nifty are Coal India and L&T. Coal India is up almost 27%, L&T is up about 12%. A clear indicator that this entire theme is picking up, right? Power, renewables, infrastructure, capital goods. From that, universe, which are the stocks that you still like?
So, Sonia, you rightly highlighted there is been a surge in the power demand in India. We are currently, I think, decadal high demand, and that is helping some of these stocks. Even on the infra side, the post the weak monsoon, the construction activity has picked up pace, and that is why you see that kind of demand improvement in some of the stocks. Specifically, if you look at Coal India, it's a kind of a value stock. It had corrected a bit in the current environment, offers a high dividend yield. Coal demand has been improved. Coal prices are inching up. That is supporting the sentiments for Coal India. L&T, the buyback just got over. The company had raised the buyback price from 3,000 to 3,200. On the retail side, there is the news that almost 100% acceptance is there. And that is why there is again some demand coming back into the stock. So if you look at the overall picture, Larsen is the best play to kind of look at the entire cap goods infra space in India, and that continues to be our preferred pick within the capex theme. And if you look at the overall power sector, we like both Coal India as well as NTPC. So one is at the coal side and the other is on the generation side. Both are likely to do well. We have seen that, as I said, power demand at multi-year high, which should only improve with the monsoon now getting over and with the capacity utilization improving for the industrials.
Okay. Siddhartha, hi, good morning. This news flow on MCX is a bit of a setback, isn't it, after yesterday's move higher? How do you read this, and do you think it'll be a temporary one? I mean, eventually this will happen. I mean, it's a matter of time, but nevertheless a bit of a setback.
Yeah, Prashant. So as we all know, the technology partner, or you can say the platform change, has been a big overhang for MCX. So when the company announced that it will finally move over from 63 moons to TCS, the market definitely cheered that. But now with SEBI notification coming in that they will have to wait for approval, it does add to an overhang for some days. So maybe because of the sharp up move that we saw in MCX yesterday, the stock might see some pressure today. But you rightly highlighted, yes, now since that they have done all the testings and everything is in place, it is a matter of time when they will shift, and they will have to shift because the agreement that they had extended is only till this year end, that is up to December. The question also remains on the business as to the new contract that they would have to launch from January. That is also now a bit of overhang because that will require the approval from SEBI. So it means that for some time there will be an overhang. But if you look at core business, option business for MCX has seen sharp improvement. This will be a big positive that they move away from 63 moons to TCS so that the long-term business viability improves. But as you rightly said, yes, in the near term, till the SEBI approval comes, one needs to be cautious. But the news that TCS platform is ready to go live is definitely a big positive for MCX.
All right, stay on. I do want
Siddhartha Khemka as well, who's still waiting by. I said thanks for waiting by. I wanted to ask you about Vedanta Limited. You know, the company clearly is under pressure because the parent is under pressure with regard to their debt repayments. Valuation-wise, it looks good. The problem is, will the parent be able to sort out its issues? Now, there is a rumor that they could look to demerge their businesses, and they mentioned that in the past as well. Do you see things change, or from the metal space, do you have a better pick?
So, Nigel, I think Vedanta has been in news historically for the kind of corporate development that keep coming up. A lot of news flows with regards to the parent entity and the debt that they have in the books and how they want to take money from the listed entity into the parent entity to pay off those debts. So there have been earlier attempts at delisting to demergers, and they have not been able to surpass that. So I think that will remain an overhang. Valuations are definitely attractive, but on the overall metal side, things are not looking that great. Specifically for if you look at a large conglomerate like Vedanta. Separately, if you look at on the ferrous side, we have seen last couple of months, recently also some of the domestic steel companies have raised prices on back of improvement in demand. Costs have definitely gone up, but they have been able to pass on these costs as price hikes, so that there is a good steady demand in the domestic environment. So we would rather focus on these pure plays on the metal side, which we believe are likely to do well with the capex cycle, with the infrastructure, housing sector doing well. So demand for some of these steel companies would be strong. So companies that we like are Jindal Steel. If you incidentally look at Jindal Steel and Power, which is our preferred pick there, the company has been increasing its capacity significantly, and they plan to enhance the overall crude steel capacity to 15.9 metric tons from current million tons from current 9.6 million tons. They also are looking to ramp up their coal mines capacity so that in future they would have almost 50% of their coal from the internal thermal coal requirement, and reducing the dependence on import as well as merchant coal mines. So all this put together looks Jindal Steel looks good and attractive to us. Valuations are also comfortable, and debt has also come down in the last couple of quarters. So it is one of the strongest balance sheets among the domestic manufacturers. It trades at about 4.8 times on FY25 EV/EBITDA, and we believe that gives a decent upside. We have a target price of 790, which kind of is a 15-16% upside.
Okay, all right. Thanks a lot for that. Well.